Hello, everyone. I'm going to go ahead and start our lecture for this week, starting with our discussion of how midterm 2 went. And so I'm going to go ahead and take a look at the quiz statistics for midterm 2. And you can see that, again, we had a very good outcome for the exam, 91%, high score of 100%. And then you can see some of the other information here. But again, I think having an A average on the exam looks like things are working for us here with the idea of watching the lectures, as you're obviously doing, and then working through the slide material from the textbook, and then looking at some of those practice midterms, as I think you probably saw, are very closely aligned to what we see on the exam. So we're going to continue with that pattern. As you can see, I'm going to give you the lecture for chapter 5 and 6 today. Next week, chapter 9 and 10. And then the exam will cover those chapters 5, 6, 10, and 9 that have occurred since the last midterm. It'll be similar format as we've seen, the 25 multiple choice questions, worth 4 points each for a total of 100 on the final. So make sure that you are observing when the exam will be given. It'll be the same system where we open it up on the Monday, June 26th. I will leave it open that entire week, as we've done in the past, so that it will close on the Saturday. The exam will close on Saturday, or actually Sunday, July 2nd at 11:59. It'll open at 12 a.m. on the 26th, and then it'll stay open until 11:59 on July 2nd. It'll close hard, and then make sure you've turned in all assignments at that point in time, as I do need to go to grades relatively quickly after the end of the term, and so I don't have time to extend for anybody not able to turn in an assignment. Okay, so we're getting close to the end, but we do have some more work to go. So I want to go ahead and I'll start with the chapter 5 material here, dealing with check tamper. And I don't know if any of you have ever seen the movie Catch Me If You Can. It's a movie with Leonardo DiCaprio. Fun, entertaining movie. Leonardo DiCaprio is in there, and he's altering checks, and the whole time he's being chased by Detective Tom Hanks, and he's getting away with this lifestyle because he knows how to tamper checks. And it's set back in the 60s, so it's a little bit dated, but for someone that's taking this class as an accountant, you might find that an entertaining movie to check out at some point in time. So that's what we're talking about. We're talking about schemes, fraud schemes, of course, where a employee most likely is intercepting a check somehow and then misappropriating the funds accordingly as they try to negotiate those checks. And so in our usual format, we're going to talk about what some of the schemes are, and then probably more importantly, how to detect those particular schemes. Now, when you look, you could have a forged maker. The maker is the entity that owns the bank account against which the check will be negotiated. And then there is an authorized signer who can also be considered the maker if they also own the account. Regardless, the maker is the one who ultimately authorizes any signing authority on checks. Forged endorsement. So when we have a forged endorsement, somebody takes a check, somehow they intercept that check, and they sign on the back to say that they indeed are the person that was the payee that's cashing the check, but they forged that signature. Altering the payee. Who's the payee? Paid to the order of, and they just simply falsify the name there. Concealed checks are basically sitting there saying, well, I have a supervisor. The supervisor is very busy. I'm going to submit a bunch of checks for them to review, and I'm going to slip in this inappropriate disbursement check in there, and they'll just sign off on that, and they'll never notice a difference because they're too busy to go through and look in detail of all the different checks. And then it could be someone who is actually authorized to sign the check but starts altering it accordingly so that they can negotiate that fraudulently. So these are the different things that we're talking about. You can see as we looked at this slide in several other chapters, check tampering, can account for accounts for some 25% of fraudulent disbursements here. We've talked about some of these other type of schemes in some of the other chapters. And then you can see check tampering from a dollar amount standpoint is pretty high up on the list. So something worth us taking a look at and understanding. So let's take a look at check tampering schemes, and the perpetrator physically prepares a fraudulent check. And to do this, they would need to have access to check stop, bank statements so they can later conceal this inappropriate stealing of the check, access to the cash disbursements journal to further help them to conceal the fraud, and then ability to forge signatures or other information on the check. So they need to be able to do these things. And as I've mentioned, and I'm sure you probably have that rattling around in your head now because we've said it so many times, separation of duty cures a lot of this kind of problem. Okay, but if you don't appropriately separate some of these things, you let people have these different accesses that you see here listed on the screen, then that's going to allow somebody to potentially tamper with the check. So forge maker schemes, an employee misappropriates a check and fraudulently affixes the signature of an authorized maker. Now, in order to do this, they have to have access to the blank check stock, convincing forgery of authorized signature. And we're going to talk about different ways they might do that. And some ways are more convincing than others. And then the ability to conceal the crime, again, having access, as we saw in the previous slide, to the bank statements and the disbursements journals, the counting records. So employees having access to the company obtaining the check, they have access to, this is actually a listing of employees that have that access: account payable clerks, office managers, bookkeepers, some employees who don't have access to company checks, but the checks are just not properly secured. They're poorly guarded. Okay. And then of course they could be producing counterfeit checks, which is not that difficult, right, in today's day and age where printers can be used to produce checks and whatnot. And so that could be a problem as well. So how to safeguard checks, and we say maintain them under lock and key. Access limited to those who have check preparation duties. Boxes of blank checks should be sealed with security tape. Periodically check the security of unused checks. Voided checks should be promptly destroyed, shredded, whatever. Checks should be printed on watermarked paper. Producing watermarked paper is, not that costly if you do it on a large volume of items. Okay, so when a check producer, a company that produces the checks, they can put that watermark on there because there may be, producing tens and hundreds of thousands, not millions of checks. So putting that watermark is cost effective for them. That's part of what happens when you have a credit card and you have that little chip on the credit card, and that chip is used to identify you and whatnot. It is very difficult to try to mass produce those chips. So that little shiny little thing that looks like a little hologram thing on there, that is very cost prohibitive to produce on a one-off basis. So you'd have to produce tens and millions of them to be cost effective. The federal government uses those watermark techniques. So when you hold up the 100, you can see USA 100 on it. You can hold it up to the light, you see that little magnetic strip in there. That is because the federal government produces so many bills that it is cost effective for them to put that little strip. Counterfeiters, the cost of producing just the one, the economies of scale necessary to produce just the one is cost prohibitive. And so that sometimes using watermarks and those sorts of things are cost effective if you have a large volume of checks and whatnot that you're producing. Out of sequence checks and duplicate checks should be investigated. And each day, when we're dealing with checks and cash, a daily reconciliation, and in this case, the last check written on the previous day to the first check written on that next day, to make sure that there's nothing happening out of sequence. Now, if they manipulate the who the check is payable to, paid to the order of, right? Could be the perpetrator themselves, an accomplice. If they put cash on there, a check that says to cash, that's really negotiable paper. Whoever holds that check, all they have to do is endorse that check and sign it out, and it'll be cashed theoretically. A lot of institutions will say, well, no, we're not doing that because this doesn't happen that much that you see a check to cash. And so a lot of companies themselves will refuse to negotiate that check. And then it could be made payable to a vendor, and then maybe they're thinking that they're going to intercept that check somehow, even though it's payable to the vendor. Forging, freehand forgery, trying to match the signature as closely as possible. Not the best way to forge a signature, but some people may have some talent in that area. Photocopy forgeries, they take a signature from an actual authorized signer and they somehow photocopy that and then affix it to the check that they're tampering with. Automatic check signing mechanisms can produce a perfect forgery, and it makes it look like it was actually signed, but in fact it wasn't. So, we kind of went down the list. We got more sophisticated here, right? Converting the check, fake identification may be needed. Maybe the person will make a fake identification of someone that they know regularly receives some sort of check, and they can intercept that check, and they just make out a fake ID so they can cash it. Or maybe the person doesn't want you to know that it's them, right? So they make up a name, an alias, and then they go ahead and make a fake identification in that alias's name. Check payable to cash only requires the endorsement of the person holding the check, thus leaving a clue as to the identity of the forger. Of course, again, the forger would be kind of not the most sophisticated fraudster if they sat there and used their own name, so they probably would be using a fake name for that. But again, many institutions just won't negotiate a check that is to cash, and so that's the actual person, liquidating that check, putting up a guard on themselves so they don't get caught in the middle of this sort of fraud scheme that's going on. Preventing and detecting safeguard blank check stop. I have a little story. I was on an assignment, as you know, as I've mentioned. I worked for the federal government for 26 years, and one of the things we did was we looked at the way checks are dispersed, federal checks are dispersed. And it's basically a factory where checks sit on a spool of 40,000 checks at a time, and they run through, and the checks literally get cut as they go through this process. Well, it's easy to say safeguard blank check stop. If you're talking about a spool of 40,000 checks, that's moved around by a pallet and whatnot. So in that case, safeguard would have to be a safe large enough to be able to fit, a whole big spool of 40,000 checks on it in that particular case. So of course, safeguarding blank check stop is not a one size fits all endeavor. Establish rules of custody of checks that have been prepared but not signed. Separate duties of the check preparer and check signers. Again, separation of duties is the way to, the best way to get through some of these things. And of course, the larger the entity, the easier the separation of duties. Smaller entities, not so much. Rotate authorized check signers when possible, and strictly limit access to any kind of signature stamp, that sort of thing. Forged endorsement schemes. So the employee intercepts a check intended for a third party and simply signs as the endorser on the back of the check, whoever it's made out to, and they simply sign it and they forge that. Intercepting checks before delivery. Obviously, the employee would have to be somehow involved in the delivery, or if there's poor control over signed checks, maybe they commandeer them before they're mailed out. Theft of return checks. Maybe a check is sent somewhere to a inappropriate vendor, and then the check comes back. The vendor says, well, this isn't for me. They send the check, and when it comes back, they take the check. Rerouting the delivery of checks so that they come to the perpetrator, and then converting the stolen check, essentially cashing the stolen check. Separating the function of cutting checks. By the way, cutting checks, guys, comes from this notion that when a lot of checks are produced, they're all, like I mentioned, on a big spool, and then they are literally cut by a machine that cuts the check by, each check that needs to be separated. They cut the checks that way. You've I'm sure, seen a checkbook where you tear the check out, but cutting means when you have a lot of checks going through. So separate the function between the production of the check, the signing, and the delivery of the check. Okay, and then of course, they're not mentioning it here, because they're actually talking about the possession of the check, but then any releasing of funds, any reconciliation should be separated from these functions as well. Employees should be trained in indicators of possible check schemes, investigating vendors and customer complaints, because the vendor, the customer is going to say, I paid that bill, why didn't you credit my account? Maybe the check that they sent was commandeered by the fraudster, and therefore they didn't get credit for having made their payment. Of course, people don't like that, and they go ahead and maybe start to complain about that. And then if there are duplicate payment amounts, same vendor, same amount, same day, a couple of days apart or something, those should be investigated as well. Coming on, continue with how to detect the theft of outgoing company payments. Authority to make changes to vendors should be restricted. Someone who has access to checks should not be able to change the vendor information. Periodically report listing all changes. Vendors' records should be generated to determine if there's an unusual number of changes being made. Investigating canceled checks with dual endorsements and non-payroll checks. If something's signed by an employee, how come? Obviously, if it's a payroll check, that makes sense, but vendor checks, the employees really shouldn't be endorsing those. Chart the date of mailing for every outgoing check so that if a check is stolen, you can determine who worked in the mailroom on that date. With these changing of the vendors, periodically, there should probably be, not periodically, but on the occurrence of the change in the vendor, you really should be reaching out to the vendor, having an independent person reach out to the vendor and say, hey, are you really changing your bank routing information? Are you really changing banks? Have you changed from B of A to Wells Fargo to Chase, whatever? Having a conversation. I know that these days everyone sort of wants to do everything without calling and without sending a text and that sort of stuff, but people really don't mind text so much, but talking to a human being, communicating with a human being is often a good way of identifying maybe there was an unauthorized change to a vendor. Alter payee schemes. So the employee intercepts a check that is intended for a legitimate third party. The payee designation is altered, changed somehow, and then they tell us less chance of discovery unless checks are canceled checks are reviewed during reconciliation. Quick set of procedures. When canceled checks come in, hey, were there any changes to the payee? Company policy is the payee should not be changed. If there needs to be a change to payee, the original check should be destroyed and a new check issued. So how come we have checks that are coming in with alteration of the payee, etc.? So what they'll do is they'll go ahead, they'll alter, they'll put a false payee's name instead of the true payee's name. Accounts payable system is manipulated to the change payee's name, and then just tacking on letters, okay, adding a few more letters to turn John into Jason or something. I don't know how you would work that. And you go ahead and, you're then able to negotiate that check. Using erasable ink, okay. Blank checks, authorized sign a blank check to be filled in by the fraudster. I don't know why someone would sign a blank check. I mean, maybe you sign a blank check to your mother, okay, but I don't know under what circumstances you'd really be handing out signed blank checks, but I guess sometimes maybe it happens. Going through and having proper separation of duties and check preparation, signing, and delivery, separation of duties and check reconciliation process, okay. Check canceled, check the canceled check against the entry in the books, and consider using carbon copy of checks against canceled checks for discrepancies. All of these things, and again, remember separating the custody of the asset from the authorization, and then the record keeping is what we've talked about. So preparing the check would sort of be the custody, signing the authorization, delivery is a custody issue, but then these things of going through and reconciling and whatnot with the accounting records, that's a record keeping function that should be separated from the authorization and the custody, right? And coming over, employee prepares a fraudulent check, concealed check scheme, and a concealed check scheme, and submits it along with legitimate checks. So they are relying on a busy reviewer who's just going to, and there's a fraudulent check right there in front of them, and they don't detect it because they're busy, they got a bad day, and the person that's doing that knows the time when they're going to be swamped with a lot of different things, and that's when they ask those to be submitted. So having a well-established time as to when checks will be reviewed before they go out, so that the person that's responsible for that has the sufficient time, bandwidth, attention span, whatnot, to be able to sit there and properly do that authorization. And then a check could be payable. In that situation, the concealed check is payable to an employee or an accomplice or something like that, and they're relying on the busy reviewer not to catch that. Authorized maker schemes. So we have an employee that has the authority and they write a check. Perhaps they've overridden some controls if they're a high-level manager and whatnot. Failure to closely monitor the accounts would be an example of poor controls. And then, as we have said, separation of duties, lack of is a problem, right? We need to keep these authorization, record keeping, custody separated, and I've mentioned that here now a number of times. So how can we detect? It's difficult to detect because check signers are relied on to service control. You want to separate the duties of the check preparer and the check signer. Check signers should not have access to blank checks. They should not have access to accounting records. I know I've said that a number of times now. If it's a large dollar amount, require dual signature, and then maintain up-to-date vendor list and confirm all disbursements to the list. So if there's some weird name coming through there, that is going to be looked at. Forged endorsement schemes, altering the payee's name and then going ahead and endorsing the check in that endorser's the endorser endorses the check in the fraudulent payee's name, and then the investigation would be triggered and the fraud would be discovered. But the issue there is that the person that didn't get credit for their payment, they may complain, and that might be where this thing gets investigated and discovered. Fraudulent fraudster concealing the bank statement to remove the fraudulent check, doctor the bank statement. Code checks is void or don't include them in the disbursements journal. Again, if you have the ability to create the check, custody the check, you should have access to accounting records. Realteration of check is changed back to the rightful payee when returned from the bank, and altered checks will match the names of legitimate payees listed in the disbursements journal. Again, you're going to have a vendor, a customer saying, where's our money? So eventually that would get it covered, but maybe by then the person skipped town or whatever and they're gone. So doing this, waiting for complaints is not a very good control. Okay, so you want to make sure that you've got these sort of controls in place. If a check is a new check is issued, then they would go ahead and intercept the reissued checks to replace the ones that the vendor did not receive. The original invoice will be changed in a manner that avoids looking for a duplicate check. New check is issued and stop payment is supposed to have been made, but they've actually cashed the first check and just reissued another one to the vendor, so the vendor won't complain. And, nobody checks and say, well, why did we send two? Or they alter some record somehow to make it look like two were sent. So they make some bogus supporting documents to support the check, and then they falsify vouchers and whatnot. Electronic payment tampering, probably more relevant these days, in that most entities don't want to have paper checks, so they'll use some sort of ACH payments, online bill payments, wire transfers. Okay. Now, what happens? The method used to manipulate electronic payments, abusing legitimate access to employers' payment systems. The authority to release payments is a high-level authority. This should be held in the hands of maybe 1-2 individuals in the company, a treasurer, somebody like that. Exploiting weaknesses in the internal control would be if there's not proper password protection, or you've given those responsibilities out to too many individuals, or, sorry guys, I got to say it again, improper separation of duties. Okay, the entities that the individuals in the system that have the authority to prepare a check and then update accounting records should not also have the same level of authority that allows them to release the payment. And you can set up IT internal controls in the system that I can prepare the check, but then I have to send it to the treasurer, and the treasurer doesn't have the ability in the system to prepare the check. They do have the authority to release the payment after they've looked at some supporting documentation and whatnot. For example, the vendor's invoice. Okay, so that's basically what I was just saying. I want you to click the slide over, separation of duties between those different functions in the system. Daily account monitoring and reconciliation when you're dealing with cash. You don't want to wait till the end of the year to reconcile your cash, right? That's something that can probably be done daily, at least monthly, with the bank reconciliation. And then again, managing the access to the different levels of authority within the system. There are bank security services, so you can set up something called positive pay, which will include ACH blocks and filters. So if you do have automated clearinghouse payments going through, before they go through, you have to compare the proper names and see that everything looks okay before the account is actually debited. So this happens when I say the account is debited, I mean your bank account is debited by the bank. Basically, before you're going to have to authorize the bank to release the payment. So now the check is there; it's ready to be cashed. It's ready. Your bank is ready to send the funds out, and you do some sort of check on those checks before you actually authorize the bank to release those. And so banks will do that. There's different software that would allow you to separate duties of reviewing the bank statements, initiating the payments, etc. So you can see some of these different things. Multi-factor authentication tools, tokens. Hey, do you really want to release these funds? And the person says yes, and then a code is sent to, say, a company controlled text phone, cell phone, where it says before you release this, you have to enter the code that's sent to the text of the person who actually has the authorization, right? Instead, in case somebody has somehow gone in and gained access to releasing payments that should not, right? Okay, good. So that gives you a sense of some of the check schemes. Now, I also wanted us to talk in this discussion about Chapter 6 now, which starts to talk about payroll schemes, because again, we're talking about what? Intercepting legitimate payments and whatnot, or making false payments through check and payroll checks. In fact, again, I'm going to go back to my example of the Catch Me If You Can movie. If you notice in that movie, if you watch it closely, what he was really, the checks that he was negotiating were payroll checks. And payroll checks, are widely distributed. Okay, now, these days, a lot of companies, a lot of entities have direct deposit, which is used. And so we'll talk a little bit about direct deposit here. But a lot of entities will go ahead and farm out their payroll to, say, ACA, not ACH, but the payroll company, ADP. They'll go ahead and they'll farm that out to somebody like ADP, which is huge. I mean, ADP, sometimes you'll see that when there's going to be an employment report that's going to be released by the Federal Department of Labor, the ADP will predict what's going to be in that report before it's released by the government. And they are able to be pretty high batting average with what that's going to be because of the amount of payroll that they process. And they're probably able to do some sort of statistical extrapolation based on the amount, the volume of transactions that they process. Their sample size is probably pretty indicative of what's going on in the overall economy. So that's just a testament as to the volume of transactions that they produce. And so if you have a company that is using ADP, ADP, I would be willing to bet money, I haven't read this anywhere, but ADP probably has an auditor who comes in and looks at their systems and can issue trust letters to various companies saying, hey, our systems are secure for safeguarding data, being, we've done penetration testing. You can't really hack them and go in and change payroll records and whatnot. And I'm sure ADP pays a good chunk of money to have that done, but it's worth it to them because their clients may be worried about those sort of things. So we don't talk so much about third service payroll providers, but that's something to keep in the back of your mind. That is something that is out there, and there are some ways to getting some assurances that they're doing that work correctly. Okay, but you take a look at payroll schemes here, ghost employees, commission schemes. I want to get paid because I've sold something, so I pad my sales so that I can get the commission on that. Falsified wages. So taking a look, again, you can see we're at check tampering. We saw this slide a minute ago, large dollar amount. Okay, and then occupational fraud, we've talked about in some earlier discussions, is when the employee who actually works for the company is committing the fraud. And you can see some of the schemes that we've already sort of outlined on that green drop down slide we saw a minute ago. So someone has to ghost employees when someone who does not actually work for the company and we act like they do. So it could be a fictitious person. Maybe they start to get payroll checks issued to a friend or a relative, another accomplice, right? Now you come over and how do they add the ghost employee? They have to go through the personnel department. So they'd have to have some hiring authority. Then they have to get that through the payroll department. Maybe they use names that are similar to employees. So, subconsciously, even though it's not quite the same name, it's not setting off any red flags because it's close to a name that I'm used to. Failing to remove terminated employees from the payroll so that the check continues to come even though the person was terminated. Now, again, we would need to make fake time cards, not we, but the fraudster. There need to be approval of those. If there are computerized timekeeping systems, then there would have to be some hacking going on there. Or you could have salaried workers or hourly workers that you're having fraudulent times being put in for. Issuing the ghost paycheck and delivery of the paycheck if it's hand delivered, mailed to the employee's address, or direct deposited. So let's take a look. And again, separation of duties. Someone needs to go through the HR department before they are authorized for their pay rate. They've been hired, okay, they've gone through the appropriate process. We have a W-4 on file for them. All of those things need to happen in human resources, not in the payroll department, okay? Then the personnel records will be maintained, will be independently maintained from payroll and timekeeping functions, okay? And then what? Personnel department should verify any changes to the payroll, and then making background reference checks to make sure the person is an actual person that's been hired. Again, separation of duties, right? Periodically check the payroll records against personnel records. If somebody's been terminated, why are we issuing a check to them 2 and 3 months after they've been terminated? Periodically run computer records for checks that are being issued to someone that doesn't have a social security number. No withholding, deductions, no physical address or telephone number. All of these things would be very strange anomalies that should be caught. In fact, you should set up a preventative control that doesn't allow a transaction to go through if any of these problems are going on. Compare payroll expenses to production schedules. Keep signed checks, and checks need to be in a secure location. And I'm not sure why checks would necessarily be signed in advance of actually being prepared. Verify proper distribution, require employee identification in the event that the employee is receiving a physical check, which doesn't happen that much these days. Almost everybody's using direct deposit. Overpayment of wages is the most common. So now we're going to increase the number of hours or the pay rate. Again, HR is the one that should know the pay rates, not the same people that are doing the accounting records. Computer tracking of the employee time. Manually prepared time cards, obviously going to be a little more susceptible to some sort of fraud than if you have an actual electronic or mechanical recording of folks' time. Manually prepared time cards forge the signature. There may be collusion. Maybe you have rubber stamp supervisors. I'll get this time card out of my face. Poor custody procedures. I worked at a hospital, and they used to have the policy that on Saturday night, they would put out the time card for that Sunday that people were going to be coming in early and working on Sunday. So the time card would be out on Saturday night or Sunday. Well, what it would allow someone to do is come and punch in for the Saturday night that was going to happen that next week. They'd be able to punch in and out on that Saturday night because that card was for the following Sunday. And the thing didn't put the actual date that they punched in and out, just if they had punched in and out on what was indicated on Saturday on that time card. So poor custody procedures like that over time cards would be a problem. Time clocks and other automated timekeeping systems, employee has someone else clock in for them or out for them. And then again, manipulating rates of pay. So again, preparation, authorization, distribution, reconciliation, hiring should be separated, transfer funds from general accounts. Payroll really should have an impressed account, and that the payroll checks should only run against a certain account that has enough in there to meet payroll, so that the company's entire cash isn't subject to these widely distributed payroll checks that are going all over the place. You can have, all your cash wiped out if you do something like that. So impress the payroll so that only enough to meet payroll is contained in that account. So if somebody tries to walk away with the bank, through a payroll check, it'll be stopped, right? Overtime should not be paid unless authorized. Sick leave and vacation time should not be granted without supervisory review and monitored for excessive time taken. I think the supervisor is probably going to know if somebody's on vacation or didn't show up, and so that one would be kind of a tough one to get away with. Taking a look, designating official who should verify all wage rate changes. Again, someone in HR, but maybe that even needs to go higher up in the entity, depending on the size. Maybe we have the, CFO authorizing those pay changes. Time cards should be taken directly to the payroll department after approval. Again, time cards being properly secured, and run programs to actively seek out fraudulent payroll activity. Review employees who have significantly more overtime than others, a trend analysis, budget versus actual. Payroll should be pretty close. There shouldn't be a lot of variance between what was budgeted for the payroll and the actual. And if there is a variance that's fairly large, I'd say probably there's no, standard for that, but I'd say, more than 20%, 10, 20%, that's an event that should be significant enough that everyone would know why that happened. Well, we had this big order and we had to work overtime, whatever it was. So there shouldn't be a lot of discrepancy between the budget and the actual for payroll. Running exception reports for large increases, verify payroll taxes, equal with federal return tax forms. And what they're talking about, they probably shouldn't call it a federal return tax form. There's a form called 941, and in the 941, that needs to be filed for withholding of federal tax and whatnot. That's the return that they're talking about for the withholding, and then looking at net payroll to payroll checks issued. Commission schemes. So we didn't really talk about so much about direct deposit there, which is used pretty commonly. So with direct deposit, when an employee comes in, they have to fill out that direct deposit authorization and have to sign off on that and whatnot. So there should be some sort of computerized listing, right, of all of the bank routing numbers that have been authorized for employees. And if there's, a disbursement that's getting ready to go out, there should be a run check against those routing numbers that were already established through that control process of the direct deposit, and checks that are going to payroll checks that are not going to specific, that's on that direct deposit authorization form, that the bank routing number that was there. If there's a payroll check going to that number, well, that should be stopped. The other thing is you can put it in control in there so that no payroll payment goes out that is in excess of and just pick the largest salary in the company, whatever it is, and there shouldn't be an amount that should go out over that. And then there should be some sort of, hey, the average payroll is supposed to be so much. If the average is more, so there are all kinds of, through direct deposit, different EDP type controls that could be put in to prevent things from going out that aren't supposed to. And then again, a lot of companies will use a third-party provider, but you do probably want something from that third-party provider that has said that they've had their systems looked at and they can't be hacked into and that sort of thing. Okay. All right, good. Coming over and taking a look at commission schemes. So employee is paid for whatever they sell, let's say, they're paid a commission on that. And so what employees might do is create fraudulent sales orders, customer purchase orders, credit authorizations, ring up a false sale, overstate sales, trying to fraudulently increase the rate of commission. So to detect some of those, run periodic reports on an unusual relationship between sales figures and commissions, run reports and compare commissions earned amongst salespersons, track uncollected sales. If they're by salesperson, if they're putting down fake sales, they're not going to collect on those, right? And then conduct random samples of customers to verify that the customer exists. And to the customer standpoint, you don't call a customer and say, we want to make sure this sale is legitimate. You call a customer and say, how do you like that? How are those things we sold you working out? And the customer thinks, oh boy, what customer service, right? Meanwhile, we're checking to see that this customer is really out there. It's an existence test. Okay, good. So we've looked at some of those things. So I want to take some time now to go ahead and you saw the syllabus earlier. It looks like I have to find my practice midterm. I thought I had that open. There it is. Easy enough to open it here. Okay, and let's go ahead and let's take a look at that. So we're going to look at a few questions here. So again, doing good at these questions has parlayed into what? Understanding this is parlayed into doing well in the exams, right? So number one, to successfully carry out and conceal a check tampering scheme, the fraudster must have access to the check stub, access to the bank statements, the ability to forge signatures, okay? All of the above. And so keeping these things separated would prevent that, right? The person who prepares and signs the check is known as the maker, okay? The person that signs, maker technically means the entity that owns the bank account, but then the maker, the person who owns the bank account, can authorize a signer. And so the signer becomes the agent of the entity and they step into the role of the maker. Number four, which of the following is not an effective control mechanism to safeguard an organization's check stocks? Making sure that the checks are properly secured, check the check stock, do an inventory of it and whatnot. D, voided checks should be properly destroyed. C, the employee in charge of the check preparation function should periodically verify the security. No, if they're preparing checks, they shouldn't have necessarily the custody of the blank checks, unused checks. They should probably have to go to a separate person to get those, and then they go ahead and start to prepare them. And then again, separating the releasing of the funds, even from that check preparer, and then of course all the record keeping should be separated as well. So to prevent forged maker schemes, an organization should separate duties of the preparation of the check, signing of the check, rotate authorized check signers, maintain a usage log for any signature, stamps. All of these are good ways to prevent the forgery. Which of the following computer audit tests can be used to detect forged maker schemes? Extract checks that are out of sequence, extract manual checks and summarize by vendor and issuer, extract all checks payable to cash. All of these are good controls. Let's take a look at number 6. Billy Hodges was in charge of preparing checks for the Lightner Company. He entered the payment information into the accounting system, and completed checks were sent back to him for review. Already problems, right? He then forwarded the checks to his supervisor for signing. In each batch of legitimate checks, Hodges would insert checks made payable to himself. When the supervisor was busy, he would take the stack of checks to him and ask him to sign them independently in order to meet the cycle time deadline, right? Hit the guy when he's busy. The supervisor would inattentively sign the checks, and then Hodges would extract the checks he made to himself. This is an example of concealed check scheme. I don't see how something like this happens, but okay, I guess it has happened in the past. Otherwise, it wouldn't be here. The supervisor better wake up. And this Billy Hodges is skating on thin ice. Okay, number 7. A ghost employee is an individual on the payroll who does not actually work for the organization, right? Which of the following is not a type of payroll scheme? False deduction scheme? No. I mean, there may be something like that going on in the company. I'm not exactly sure what they would be having the false deduction for, but it's not a type of payroll scheme. I don't even know. I guess that's why it's not. I don't know what exactly that would be. So that's just a red herring there. Number 9, if a fundraiser fails to remove a terminated employee. I mean, if I look at a question like number 8 and the wrong answer here, I'm thinking this is designed, the commission scheme would be D, for someone taking this test that didn't watch the lecture. Okay. Number 9, if a fraudster fails to remove a terminated employee from the payroll and collects the former employee's fraudulent check, that is an example of what we talked about, ghost employee schemes. Number 10, which of the following procedures will not help prevent ghost employee schemes? The person responsible for hiring employees also supervises the payroll function. So they'll keep, folks may have to even think about it, that we wouldn't separate those duties. They'll go ahead, and even though the person has left, they'll go ahead, or they'll hire a fake person and then, continue to get their payroll checks coming through. Number 11, if an employee generates a much higher percentage of uncollectible sales than his coworkers, what type of scheme could they be committing? Well, look, maybe they're just having a very good month. Maybe they're a really good salesperson, right? But maybe there's a commission scheme going on. Number 12, which of the following controls will prevent and detect falsified hours and salary schemes? Separation of duty, separation of duty, separation of duty. So the duty of payroll preparation, authorization, distribution, and then the updating of the accounting records should all be separated. We've said that a number of times now. Number 13, Jim Stevens is a payroll manager for a mid-sized insurance company in the Southeast. Last year, his performance review was conducted late, so he received a retroactive pay increase because he was not authorized to access his own employee records. Stevens stole another employee's password and logged into the payroll system and manipulated the records to keep the retroactive pay increase in effect in future periods. This is falsified hours. Salary scheme. Okay, very good, guys. Continue the good work. We're in the home stretch now. We've got one more lecture to go, and then you're going to have your midterm or your final. It's like a midterm, like a glorified final. And only cover the chapters, the last few chapters we're going to cover in the course. And most of you are doing very, very well. So I'm pleased with how things are going. Hopefully you are as well. And we'll talk to you next time.